Hey there, welcome back to TradeX Pro. In our last episode, we explored the critical role of reversal chart patterns in identifying potential trend changes in the market. We began with the double top and double bottom patterns, which act as early signals of possible trend reversals. Next, we delved into the triple top and triple bottom, analyzing how these patterns provide insights into potential market shifts. Finally, we concluded with the head and shoulders pattern and its inverse, both renowned for their effectiveness in predicting major trend reversals. With these patterns in your trading toolkit, you're now well prepared to anticipate market reversals and make more informed trading decisions. Today, we'll move on to explore continuation chart patterns. These patterns signal that the current trend is likely to persist, offering traders the opportunity to capitalize on sustained market momentum. By understanding these patterns, you'll be able to identify moments when the market is taking a brief pause before continuing in its established direction, allowing you to make more confident trading decisions. Let's begin with the bullish flag and the falling wedge. Both patterns share a similar appearance and offer valuable insights into trend continuation, providing key opportunities for traders to align their strategies with prevailing market movements. The bullish flag pattern forms after a strong upward move, where the price consolidates in a narrow range, creating a rectangular flag shape. This consolidation phase represents a brief pause in the upward trend, with the market catching its breath. Once the price breaks out of this flag pattern to the upside, it often signals a continuation of the previous bullish trend. Similarly, the falling wedge is characterized by converging trend lines that slope downward. This pattern typically forms during a pullback and indicates that the price is making lower lows and lower highs at a decreasing rate. As the wedge narrows, it suggests that the bearish momentum of the pullback is weakening. A breakout to the upside often signals a potential shift back to a bullish trend. As evident from their shapes, both patterns suggest a continuation of the uptrend. While no pattern can guarantee outcomes, these patterns are highly regarded in technical analysis for their effectiveness and accuracy. Plus, they're relatively straightforward to identify in the charts. From a market psychology perspective, the bullish flag and falling wedge patterns reflect the ongoing battle between buyers and sellers. Here is one scenario. Initially, the price is low, attracting buyers who perceive it as a bargain. As the price begins to rise, some sellers start to offload their positions, believing the price has reached a favorable level, which leads to a minor pullback. These sellers might also undercut each other in an attempt to exit their positions quickly. Eventually, the sellers who bought at lower prices have cashed out, and the supply of sellers diminishes. Meanwhile, some buyers who recently entered the market, viewing the pullbacks as buying opportunities, decide to hold on to their positions with the hope of selling at higher prices. This collective action of holding onto positions and buying during pullbacks helps drive the price higher. Let's look at some examples. Here, the price first rises continuously, then experiences a reasonable pullback. The chart forms a downward sloping shape resembling a flag. Once the price breaks out of the flag pattern to the upside, it continues to rise, signaling a continuation of the previous upward trend. Similarly, in this example, you can observe a brief pause in the middle of an uptrend. Initially, the price rises for an extended period, followed by a pullback, which is represented by a bullish flag pattern. After the price breaks out of the flag pattern with a noticeable gap, it continues to rise, resuming the previous upward trend. Please note that on the left side of this chart, there is another trend continuation pattern appearing during a consolidation period. We'll cover this pattern in more detail later in the video. Next, let's examine a falling wedge pattern. At first glance, it can be tricky to tell apart from a bullish flag if the pattern isn't clearly drawn on the chart. In this example, the price rises sharply on the left side and then pulls back, forming the characteristic converging trend lines of a falling wedge. Once the price breaks out of this pattern to the upside, it continues its upward trajectory, much like it does following a bullish flag. Please note that both the falling wedge and bullish flag typically lead to similar trading outcomes. Traders should not be overly concerned with achieving a perfect shape for either pattern, as they can often be used interchangeably depending on the context. This example also demonstrates the falling wedge pattern. Here, you can observe how the price forms a series of lower lows and lower highs, converging into a wedge-like shape as it pulls back. When the price breaks out to the upside from this pattern, it signals a potential shift back to an uptrend. Sometimes, during a prolonged uptrend, the market may experience several pullbacks. Traders should watch these pullbacks closely to identify opportunities for entering positions. In this example, the price pulls back twice, each time forming a bullish flag pattern that signals a potential continuation of the trend. After each pullback, the price breaks out of the pattern to the upside, resuming its upward movement. Similarly, this example illustrates two consecutive bullish flag patterns, where the price undergoes a noticeable pullback each time. In both instances, the price breaks out of the flag pattern to the upside, allowing the uptrend to continue. Many traders develop strategies for entering and exiting trades, as well as for protecting their trading accounts. Here we'll examine one popular method for setting an entry point, stop loss, and take profit. The entry point is straightforward. Traders can enter the trade once the price breaks above the flag pattern. Some traders only consider a breakout valid if it occurs after the candle has closed, rather than just when the wick surpasses the pattern. This approach helps confirm the breakout and reduces the risk of false signals. For the stop loss, a common approach is to place it just beneath the most recent pullback low, right before the price rises and breaks out of the pattern. Setting the stop loss at this level helps limit your losses if the breakout fails and the price does not continue in the anticipated direction. Lastly, a common strategy to take profit is to set a target based on the height of the pattern. In the case of both the bullish flag and falling wedge, measure the distance from the flagpole, which represents the initial strong upward move, and project that distance upward from the breakout point. This projected distance serves as your take profit target. Let's examine some examples. On this chart, we see two bullish flags, but we'll focus on the one on the left. The entry point is triggered when the price breaks above the flag pattern. Set the stop loss at the most recent low before the breakout. To determine the take profit target, measure the height of the flagpole from the initial strong upward move, highlighted by the thick blue line, and project that distance upward from the breakout point. As you can see, the price reaches the take profit point as expected. Just like with the previous example, the falling wedge follows the same principles. Enter the trade when the price breaks above the pattern. Place the stop loss at the most recent low within the wedge. To set the take profit target, measure the height of the strong upward move before the pattern and project that distance upward from the breakout point. This approach helps in capturing the potential gains while managing the risk effectively. To reduce the risk associated with a standard entry point, traders might opt for an alternative approach. For instance, consider a small pullback in the middle of the chart. Typically, an entry is made after the price breaks out of the pattern, which often requires a significant influx of buyers to push the price up and create a strong support. If the price later returns to this support level, retests it, and then bounces back up, traders may choose to enter the market at this point. This method can offer additional assurance that the price is less likely to decline further. Traders often enhance their trading efficiency by integrating chart patterns with price action. In this example, the price initially rises and then retraces from the same level twice, establishing a strong resistance zone. Following this, the price consolidates within a falling wedge pattern, signaling potential bullish momentum. Traders have two entry options. They can enter a position when the price breaks out of the wedge, or wait for a decisive breakout above the established resistance level. To further mitigate risk, it may be prudent to wait for a retest of the previous resistance level. If the price holds firm at this level, confirming the transformation of resistance into support, traders may consider entering the trade when the price establishes a new high. Next, Let's turn our attention to the bearish flag and rising wedge patterns, which are essentially the bearish counterparts to the bullish flag and falling wedge. Both patterns indicate potential downward momentum, offering traders opportunities to capitalize on bearish market conditions. The bearish flag pattern is characterized by a sharp decline, known as the flagpole, followed by a period of consolidation that forms the flag. This consolidation phase typically trends slightly upward or sideways, indicating a temporary pause in the prevailing downtrend. Entering a short position upon the breakout is a common strategy. Similarly, the rising wedge pattern is defined by two converging trend lines, with both the support and resistance lines sloping upward. As the price approaches the apex of the wedge, the upward momentum weakens, signaling a potential reversal. This pattern often results in a bearish breakout, where the price breaks through the lower support trend line, indicating a shift in market sentiment from a bullish pullback to a continuation of the bearish trend. Both the bearish flag and rising wedge patterns can be effectively used interchangeably in downtrend continuation strategies. These patterns are easy to identify and are known for their high trading accuracy, offering traders reliable entry points in bearish market conditions. Let's explore some examples. To the left, the price experiences a sharp decline, followed by a minor pullback that lasts around 15 candles. During this pullback, a bearish flag pattern forms, signaling a potential continuation of the downtrend. Once the price breaks below the lower boundary of the pattern, traders may consider entering a short position, anticipating further downside movement. Similarly, in this downtrending market, the price undergoes several pullbacks and periods of consolidation. On the right side of the chart, the price declines sharply, highlighted by the three black crows candlestick pattern. This is followed by a minor pullback, forming a rising wedge pattern. Once the price breaks out from the wedge, the downward trend resumes, offering traders an opportunity to capitalize on the continued bearish momentum. Next example. After a prolonged downward move, the price encounters a pullback that forms a rising wedge pattern. Buyers and sellers engage in a struggle, but ultimately, sellers prevail, pushing the price down and breaking the pattern. To enter a trade when the price forms either the bearish flag or the rising wedge, traders can follow this strategy. First, enter the trade as soon as the price breaks below the pattern to the downside. Next, set a stop loss at the most recent high before the downward move to manage risk. For take profit, target a level equal to the height of the flagpole projected downward from the breakout point. This approach allows traders to capitalize on the anticipated continuation of the bearish trend while managing risk effectively. To mitigate the risk of a standard entry point, traders might opt for a different approach. In this scenario, after a significant downward move, the price undergoes a minor but prolonged pullback. The breakout point from this pattern becomes a crucial level. If the price returns to this level, tests it, and then bounces away, traders may choose to enter a short position once the price makes a new low, confirming the continuation of the downtrend. Our third continuation pattern is the ascending triangle. This pattern is well regarded for its reliability and provides a clear signal of potential bullish continuation. It is characterized by a horizontal resistance line at the top and an upward sloping trend line at the bottom. The horizontal line signifies a consistent price level where selling pressure emerges, while the rising trend line reflects a series of higher lows, indicating growing buying interest. As buyers continue to push the price higher, the pattern suggests a strong likelihood that the price will break out above the resistance level and continue rising. From a market psychology perspective, the ascending triangle can be described as follows. Initially, when the price is low, it draws in buyers who view it as a good deal. As the price starts to rise, some sellers begin to take profits, thinking the price has reached an attractive level. This selling activity leads to a brief pullback. However, new buyers view these pullbacks as buying opportunities and continue to push the price higher each time it retreats. Over time, as the initial sellers finish offloading their positions, supply diminishes. Meanwhile, new buyers who have entered the market hold on to their positions, anticipating further gains. This dynamic of reduced supply and sustained demand often leads to a continuation of the upward trend. Several examples illustrate the principle we just discussed. The price rises and then slows down in the middle of the chart. During this consolidation phase, the ascending triangle pattern forms. Buyers, having more strength, push the price higher, creating a series of higher lows. Once the price breaks through the top resistance level, it surges upward with significant momentum. Similarly, you may notice that while the price is rising, the rate of increase varies. Initially, the price climbs rapidly, but it slows down as the market enters a consolidation phase. During this phase, an ascending triangle forms with higher lows indicating strong buying pressure against a consistent resistance level. This tightening range suggests buyers are gaining control. Once the price breaks out of the triangle, it often rallies upward, signaling a continuation of the bullish trend. In this example, the uptrend experiences two pauses. The first pause forms an ascending triangle, with the price making higher lows while repeatedly hitting the same resistance level. Once the price breaks out of the triangle, it continues to rise. A second pause follows, again forming an ascending triangle. As before, traders should wait for a breakout before entering a trade. However, it's important to be cautious, as sometimes the price may break above the resistance only to pull back quickly, creating a false breakout. Traders often define entry, stop loss, and take profit for the ascending triangle using specific techniques. They enter the trade as soon as the price breaks above the horizontal resistance line of the pattern, signaling a potential continuation of the bullish trend. The stop loss is placed just below the most recent low within the pattern, typically near the rising trend line, to protect against unexpected reversals while allowing for some market fluctuation. For take profit, traders set a target based on the height of the triangle, projected upward from the breakout point, providing a clear and measurable goal that reflects the anticipated price movement following the breakout. Let's look at some examples. On the chart previously covered, an ascending triangle forms in the middle. We enter the trade after the price breaks above the resistance level and set the stop loss just below the most recent low. Next, we measure the height of the triangle and use this measurement to set our take profit. As shown, the price reaches the take profit level as anticipated. Similarly, an ascending triangle appears during the pause in the trend. Enter the trade when the price breaks above the pattern. Set the stop loss slightly below the most recent low to manage risk. Measure the height of the triangle and extend this distance upward from the breakout point to determine your take profit target. This method provides a clear goal for potential gains, and as demonstrated, the price typically reaches the take profit level as anticipated. Lastly, we can combine the ascending triangle with price action for a more refined trading strategy. During the consolidation phase following a price spike, an ascending triangle forms. Traders have two main options for entering the trade. They can either enter immediately when the pattern breaks upward or wait for the price to pull back to the key level and retest it. While entering on the breakout offers a quicker opportunity, waiting for the price to make a new high after the retest can be safer, though it may result in a slower entry with potentially smaller rewards. Our last trend continuation pattern is the descending triangle, which is essentially the inverse of the ascending triangle. It consists of a horizontal support line and a downward sloping resistance line. This pattern signals increasing selling pressure and suggests a bearish continuation. A breakout below the support line typically confirms the pattern and indicates further price decline. An example illustrates the descending triangle pattern. The price declines steadily and then slows down due to market hesitation. During this consolidation phase, the descending triangle forms, marked by lower highs and a horizontal support line. When sellers push the price below the support level, a breakout occurs, signaling a potential short trade entry. Sometimes, the market hesitation can last for months. On the chart, a descending triangle forms, signaling that this consolidation phase is nearing its end and a downward move is imminent. The pattern shows a series of lower highs reflecting persistent selling pressure. Once the price breaks below the support level, it's an ideal moment to enter a short trade. Just like with the ascending triangle, trading the descending triangle involves defining an entry point, stop loss, and take profit. Enter a short trade when the price breaks below the pattern. Set the stop loss at the most recent high within the pattern. Measure the height of the triangle and project this distance downward from the breakout point to set your take profit. As anticipated, the price typically reaches the take profit level. Our final example showcases a similar setup. The price trends downward and then consolidates, forming a descending triangle. The pattern highlights a series of lower highs and a stable support level. Enter a short trade when the price breaks below the support. Set the stop loss at the most recent high within the pattern and project the height of the triangle downward to determine your take profit. As expected, the price reaches the take profit target, confirming the bearish continuation. That wraps up our exploration of trend continuation patterns. By understanding and applying these strategies, you can better navigate market trends and make more informed trading decisions. In the next episode, we'll dive into chart patterns that can signal either trend continuation or reversal, depending on the market context. Thanks for tuning in, and we look forward to seeing you soon.